There is a date on a Social Security statement that most people never circle. It sits near the bottom of the page in small gray type, right next to the words full retirement age. For anyone born in 1960 or later, that date is the month you turn 67. Claim your benefit before it, and you can lock in as little as 70%. 70% of your full check for life. One date quietly decides more than a decade of investment returns. Most people glance right past it on the way to the mailbox. Same work record, same you, one number moved, and thousands of dollars quietly walk out the door. Here's the strange part: nobody sends you a warning. There is no red envelope, no phone call, no clerk who stops you at the counter. You just pick a date and the date does the rest. This video is about the dates that cost you money while you look the other way. So what does one wrong date actually cost? Let's put some real numbers on this decision. Say your full benefit at 67 is $2,000 a month. Claim at 62 instead, and that check can shrink to about $1,400. That gap is $600 a month, every month, for life. Over a 25-year retirement, that is more than $100,000. That is real money, not a rounding error on a form. Small timing errors compound the same way interest does. Think about that for a second. And Social Security is only the first date. There is a second one at age 73 when the government starts forcing money out of your accounts. There is a 2-year shadow that sets your Medicare premium before you enroll. These are not obscure loopholes, they are the main rules. Each of these dates has a deadline, and missing it does not shout. It just shows up smaller in your account, year after year, and you assume that is simply how retirement works. But it is not, and the whole thing is fixable in advance. So here is the deal I am making with you. I will walk you through the dates that quietly drain money, starting with the everyday ones people get wrong, then the bigger deadlines almost nobody plans for. Stay to the end because the last one ties them all together. It is not really about any single date on a calendar. It is about the one date you pick without a plan, and why that one is the most expensive of all. None of this is complicated once you can actually see the dates. Let's start with the big one, the age you claim Social Security. The SSA builds your full benefit around your full retirement age. For everyone born in 1960 or later, that age is 67. Claim earlier, and they cut your check permanently. Claim at 62 the earliest you can, and the reduction runs about 30%. That is the SSA's own math, not mine. The reduction is baked in the day your first check lands. It does not heal or adjust as the years go by. That first choice quietly echoes through every payment that follows. Now flip it the other way and wait past 67. For every year you wait up to age 70, the SSA adds 8%. Wait the full 3 years and your benefit grows by 24%. 8% a year, guaranteed, is a raise most investments envy. Delaying is one of the few guaranteed raises left in finance. Think of it like fruit on a tree. Pick it at 62 and it is small and sour. Wait, and it keeps swelling on the branch. The catch is the growth stops cold at 70. Waiting also assumes you live long enough to enjoy it, a fair worry we will come back to later. But here is the mini payoff you should hear. Between the smallest check at 62 and the biggest at 70, the monthly difference can be about 76%. Same person, same career, decided by one date. The break-even age is real, and we will weigh it honestly later. Most people pick that date on their birthday and their mood, which brings us to a smaller trap for people who claim early. Say you claim at 63 and take a part-time job. There is a rule almost nobody sees coming, the earnings test. In 2026, if you are under full retirement age all year and collecting benefits, you can earn up to $24,480. The limit nudges up a little each year with wages. Go over that line and the SSA withholds $1 for every 2. Earn well over it, and your check can drop to 0 for months. It feels like a punishment for daring to work. Many early claimers never see this rule until it hits their check. Here's the twist most people miss completely. That money is not gone forever. It is only on hold. Once you hit full retirement age, the SSA recalculates and pays it back through a slightly larger check. Still, if you did not know it was coming, watching your benefit vanish in year 1 is a nasty shock. And it only applies before your full retirement age, which tells you how much these age lines really matter. In the year you actually reach full retirement age, the rule loosens. That year, you can earn $65,160 before much is held back. And once you pass that birthday, the earnings test disappears for good. But claiming is not the only place an age flips a switch. Now, go back a few years to the line at 59 and a half. That half birthday is when the IRS stops charging an early penalty. Touch your traditional IRA or 401k before it, and on top of income tax, you usually owe 10%. Take out $20,000 at 58, and $2,000 can vanish on timing. Before that line, the government treats early access as a cost. It is like a bakery that unlocks the door at half past. Show up early, and you pay a fee to reach through the window. And being one day short earns you no mercy because the IRS runs on dates, not sympathy. The payoff is simple and worth the wait. Wait until 59 and a half, and you owe only ordinary tax. A few months of patience, thousands of dollars saved. There are narrow exceptions for disability or certain medical costs. But for most people, that half birthday is the clean line. Cross it, and one whole category of penalty simply disappears. So the everyday dates already add up fast. But the bigger deadlines, the ones with teeth, start at 73. At 73, the whole deal changes on you. For years, the government let your traditional accounts grow untaxed. At 73, under a law called Secure 2.0, it wants its cut. This is the required minimum distribution, the RMD. Starting the year you turn 73, the IRS makes you withdraw a set slice. A slice of your traditional IRA and 401k accounts, taxed as income. You pay that tax whether you need the money or not. Skip it, and here's where it really stings. The penalty is a 25% excise tax on what you missed. Fail to pull a $20,000 RMD, and that is $5,000. $5,000 in penalty on top of the tax you still owe. There is mercy if you move fast enough. Correct it within the window, and the IRS drops it to 10%. Think of the RMD as a library book with a hard due date. Ignore the notice, and the late fee is brutal. Fix it quickly, and they cut you a break. Knowing this lets you plan around it years early. The exact slice comes from an IRS table of life expectancy factors. The older you get, the larger the required percentage grows. At 73, it begins under 4% and climbs from there. The account was always going to be taxed, only the timing was yours. Which raises the obvious question, what is the actual deadline? For almost every year, the answer is December 31st. That single date is the wall for your yearly RMD. It is also the deadline for the qualified charitable distribution. If you give to charity anyway, this is a gift to yourself. Send money straight from your IRA to the charity, satisfy your RMD, and keep that amount off your taxable income. But it has to leave the account by December 31st. A gift you mail on January 2nd counts for the wrong year. December 31st is like the last train of the night. The doors close at midnight, and the conductor does not argue. One exception, your very first RMD can wait until April 1st. That sounds like a gift, but it can jam two withdrawals together. Two taxable withdrawals in 1 year is rarely what you want. The charitable distribution also has a yearly cap, indexed upward over time. For the charitably minded, it beats writing a check from the bank. The dollars never touch your tax return on the way out. A calendar reminder in early December can be worth thousands, and the smartest window to soften this bill opens years before. That window is the stretch between retiring and the year RMDs begin. Picture a couple who retires at 65 with no pension. For a few years, their income drops sharply. Maybe they have not claimed Social Security and RMDs have not started. Their tax bracket sinks into a low valley. This is the Roth conversion window, and it is precious. In those low years, you move money from a traditional IRA to a Roth. You pay tax now at the low rate, and never again. Every dollar you convert is a dollar that escapes a future RMD. There is no income limit on a conversion, unlike a contribution. You can move a little or a lot in any year you choose. The tax you prepay is small next to a future forced withdrawal. It is like buying firewood in summer when the price is low. So the coming winter does not wreck your budget. The aside here is that this takes real nerve. Voluntarily paying tax feels wrong right up until you see the alternative. Fill up the low brackets for a few years, and you shave your future RMDs and your future tax bills. A steady plan across several years beats one big rushed move. And the growth after a conversion is yours, completely tax-free. Miss the window, and it closes quietly the moment big checks begin, which is exactly where the wealthy start playing a different game. Here is what almost nobody tells you about Medicare. Your premium is not fixed, it moves with your income. If your income is high enough, you pay a surcharge called IRMAA. It stands for Income-Related Monthly Adjustment Amount, and IRMAA looks backward, which is the part that stings. Your 2026 Medicare premium is based on your 2024 tax return. That is the 2-year look back, and it catches people constantly. In 2026, the standard Part B premium is about $202 a month. Cross the first threshold, $109,000 single or $218,000 for a couple, and you pay an extra $81 a month per person. There are 5 surcharge tiers, each one its own separate cliff. At the very top, the monthly surcharge climbs past $400. The surcharge lands on Part B and Part D both. Go higher, and the surcharge climbs in steep steps. The brutal part is the cliff, not a ramp. $1 over the line, and the entire surcharge hits. So a careless Roth conversion, a home sale, a fat RMD can raise your Medicare premium 2 years later. Long after you forgot the income that caused it, think of IRMAA as a photograph taken today that does not arrive in the mail for 2 more years. If a real-life event cut your income, you can appeal it. A form called SSA 44 exists for exactly that situation. So one strong income year can echo into a pricier premium later. Know it is watching, and you can manage what it sees. And it ties into the trap that hits the middle class hardest. That trap has a name. The tax torpedo. It hides inside the way Social Security itself is taxed. The IRS looks at something called provisional income. As it rises past $25,000 single or $32,000 for a couple, more and more of your Social Security becomes taxable. Past $34,000 single or $44,000 joint, up to 85% is taxed. And here's the sting, those thresholds barely ever change. They are not indexed to inflation, so they catch more people each year. So each extra dollar from an IRA can do 2 things at once. It gets taxed itself, and it drags your Social Security into the pile. The result is a stretch where your real tax rate spikes, far above the bracket printed in the tax tables. It is like a toll that charges you for the cars behind you. Inside that zone, 1 extra dollar can be taxed like almost 2. It is the quiet reason careful retirees watch every dollar of income. There is a bit of relief right now, at least. A new senior deduction from the 2025 tax law helps. It gives people 65 and older up to $6,000 each through 2028, though it phases out at higher incomes. Understanding the torpedo lets you steer around it. The mechanics are dull, but the savings from dodging it are not. By controlling which accounts you tap and when. Think of your savings as 3 buckets with 3 different tax rules. One is taxed yearly, one on the way out, one is tax-free. This is why account order matters as much as account size. Which brings us to the move that separates the wealthy. That move is sequencing, the order you spend your accounts. Most people quietly drain the wrong bucket first. They spend taxable savings and let the traditional IRA balloon. Then they walk into giant RMDs and the tax torpedo at 73. The wealthy do it deliberately, in a chosen order. They blend withdrawals across taxable, traditional, and Roth accounts to keep their income in a chosen lane each year. The order you empty the buckets changes the lifetime bill dramatically. Same total spending, a very different tax bill. It is like a DJ mixing 3 tracks smoothly, so the volume never spikes and blows the speakers. The A side is that this work is genuinely boring. Spreadsheets and projections, which is why it stays quiet and valuable. Good sequencing can save 6 figures across a retirement. This is where a good plan spends most of its energy. A little coordination each year adds up to a lot by the end, without earning a single extra dollar of return. A Roth account has no RMD for the original owner. That makes it the last bucket the wealthy ever touch. And it works only because every date is known in advance. Sitting there on the calendar, waiting for you. Which leads to the real lesson and the last date. Now let's be honest about the other side, because waiting is never actually free. It costs you too. Every one of these dates assumes you live long enough. Take the couple choosing between claiming at 62 or 70. The 70 check is far bigger, but you wait 8 years. You collect nothing in all those years of waiting. Run the math, and the break-even usually lands in your early 80s. Live past it, and delaying wins the race easily. Die before it, and claiming early was the right call. So with a serious health condition or short family history, claiming early can be smart and rational. Not a mistake. The same honesty applies to those Roth conversions. If your retirement tax rate turns out lower than expected, you may have paid tax you did not need to. There are also spousal and survivor benefits tangled into the claiming call. A lower earner and a higher earner often claim on different dates. The higher earner waiting can protect the survivor for years. No plan survives perfectly because life refuses to run on schedule. The goal is fewer expensive surprises, not perfect prediction. None of these dates are magic. They are odds. The point is not to always wait or always convert. The point is to make the call on purpose, with the numbers in front of you, not by accident. Which brings us to the last date, the one I promised. Look back at everything we just covered together. The claiming age, the earnings test, the 59.5 line, the 73 deadline, December 31st, the Roth window, the RMDA lookback, the tax torpedo, the sequencing. Every single one is a timing decision, not an investing one. Not one asked you to earn a higher return. They asked you to move money in the right year. That is the quiet difference between a smooth retirement and a stressful one. None of it required a single hot stock or a lucky trade. And that is the twist worth sitting with. The most expensive date is not on the calendar at all. It is the date you picked without a plan. The birthday you claimed on because it simply felt right. The year you converted nothing because you never looked. The December you forgot until it was gone. Here is the line I want you to remember. In retirement, when you do things matters more than how much you have. Two people with identical savings can end $100,000 apart, purely from the order and the timing of their moves. The calendar is the same for everyone, wealthy or not. What differs is who reads it and who plans around it. The wealthy do not have secret investments to hide. They have a calendar and a plan for every date on it. The size of your pile gets you in the door. The timing decides how much of it you actually keep. Picture two neighbors, Dave and Maria, same street. Dave retired on his 62nd birthday and claimed that week. The date had arrived, so he never opened the statement again. Maria retired the same year, but she waited to claim. She filled her low brackets with careful Roth conversions. She timed her withdrawals and watched that gray line. The one near the bottom marked full retirement age. 10 years later, Dave wonders why his checks feel thin. His tax bill and his Medicare premium keep climbing. Maria draws a larger benefit and pays less tax. On nearly identical savings, same jobs, same market. The only difference was which dates they respected. The dates never move. So a plan can be ready years early. Remember that gray line nobody circles, and circle it. Then circle every other date we covered too. Circle each one in ink and check them every single year. Your future self is the one who collects the difference. If this made one date click, share it with someone retiring soon. Hit like and subscribe for boring money that quietly wins.